Hello and welcome to Trading the Trend. The question we ask ourselves every Thursday is, what trends are you riding or not riding? And we'll talk about that here today. We're going to have a little special session right at the beginning, and then we're going to hop right in. So no time to waste. My name is James Boyd. Normally teach at this time. This session is being recorded. Quick reminder that you can watch on the recording. Join us live as well. My next class after this, just a quick reminder of what I'll teach after today. Kevin and I will do the ETF class tomorrow. That's live only. That's at 9:30 a.m. Eastern. So join us there as well. I'd like to welcome Will with us, Tech One, Lena, Josh P., Chris, Elena, Robert, and many others. Welcome to all. Now, also just real quick, when we come back, I just want to take a look at this real quick. Take a look at one thing. Okay. All right. Now, Grace, hello to you. Okay, we're good. We're set up. We're ready to go. Now, the biggest actually thing is what I want to do is I want to kind of go through just real quick the disclosures real quick, and I'm going to tell you what we're going to actually discuss. So it'll be a little different session right off the bat. Now, just real quick as we get going, remember that options carry a high level of risk and are not suitable for all investors. When we talk about the examples, the information I talk about is done for general informational purposes only. Also, remember that Schwab does not recommend the use of technical analysis as a sole means of research. When we talk about examples, those will be done on the paper money software application for educational purposes only. And also remember, when we talk about examples, they are just that. And today what I want to do is right off the bat, I want to talk about what I call the short-term failure pattern. Okay. I want to take maybe 8 or 10 minutes and really kind of set up a background to what I call the short-term failure pattern. As I go through some of these things, I want you to be brutally honest with me. No one else is here, just me and Jax. And I just want you to, for example, tell me if you relate to what, for example, maybe some of us have seen. And then how do we actually try to change that short-term failure pattern? Now, as we do that, we'll talk about then after that, we'll talk about new trades. We need to talk about past trades in terms of a stop adjustments and targets. So this is going to be very systematic here today, strategy-based, based upon also psychology as well, which kind of factors into obviously reading and trading the trend. So first off, what I want to do is let me just kind of real quick, and I'm going to stay on this page for just a second, okay? So let me kind of give you a quick background, okay? Some of the background information is I want you to imagine that you have $110,000 in your paid money account, and you have about, let's say, if you were fully invested, okay, that you would actually have, let's say, about 12 positions, okay? So that's the background. Let's say you have a $110,000 portfolio, about 12 positions, okay? The bulk majority of the trades of many investors will tend to come when the VIX is, let's say, below 14. Now remember, you got to think about something. If the VIX is actually below 14, where does that probably tell us that the market is? Now, what you'll realize about many investors who actually have the short-term failure pattern is they finally buy when they feel like they're missing the trend train. They finally buy, not necessarily based on technical analysis. I'm not saying that they're not, but it's later. And for example, they're more buying based upon emotion that they feel like they're missing out on a trend, okay? Now, the biggest actually thing is, when we talk about the third thing is, have you ever realized it's a lot easier to be down 250, down 500, down 1,000 than it is to be up 250, up 500, or up 1,000. Has anyone ever experienced that? Have you ever thought to yourself, why is it easier sometimes just to be down than it is up in the short term? Why is that? Now, we're going to also talk about, so the background information is that the investor gets in, and shortly after, the market and or the stock starts pulling back. Now, what tends to happen? You don't get out because the investor just got in. And so what we now see is the market, and so the biggest actually thing is the market reverses, and all of a sudden the goal, so the market actually pulls back. You don't get out because you're thinking, well, man, I can't take these losses. I just got in, okay? And now the market reverses back to the upside, like what happened last Monday. And now all of a sudden the investor's goal is to what? What's the goal? The goal is just to get to break even, okay? And so now when those trades, if they come back up higher than what the investor bought them for, they might grab $100, $200 gains when they were down 800-ish, hypothetically, a couple $100 a piece. So they actually have small gains, and they have potentially big losses if they lock those in. Now, that's the background kind of story and information. Now, who's the story about? That's kind of like the path I went on. I didn't have any coaching, anything like that. I got started right after the Vietnam War. It was pretty close right after that. But the biggest actually thing is that's kind of my start into the stock market. That's what it felt like. Now, the biggest thing is, do you relate? Now, let's talk about the lessons learned, okay? And this is actually very important that I kind of talk about the lessons learned, because remember, the point of what we're talking about is the shorter term failure pattern. And I think a lot of people, if they actually experience this, what actually tends to happen is they might say, geez, maybe the stock market's, maybe it's not for me. So the biggest actually thing is, if the VIX, and I want to actually type this in, let me just type it in here, okay? And I'm going to take this all the way out. Let me just kind of use this. So lessons that some investors have actually learned, okay? So if the VIX is lower than 14, what might the investor actually do? To not have maybe as many experiences of that short-term failure pattern, they might actually say, James, I'm going to do maybe married puts. What is a married put? If they're going to buy stock, they're actually buying the long put. The key word is together. Now, the biggest thing about a married put is they're actually saying, I want a built-in defined risk trade. Not something that can go down to 10, 20, 30, 40, 50 points, okay? They want to actually know that, hey, is the loss built in? The other thing the investor might do is they might say, James, I'm going to color the position. The other thing they actually might do is, if they're going to take those shorter term type of trades, they have short term exits. And what I'm talking about that is they're actually setting stops. They're not thinking about where the stop is. They have one set. The other thing is they're trying to limit the short puts, and it's probably going to be, for some investors, not all, 3 or less. Can anyone explain to me why that would be pretty important? Why would that be pretty important? If the VIX is, let's say, below 14-ish, okay, why is maybe being careful on selling puts kind of important? Well, because if that trend changes right after you get in, well, all of a sudden you actually get, let's say, the price going against you, but you get the volatility also going up, and that makes the investor experience what we call double whammy. Volatility going up, pushing up the option price to buy it back at a most likely a loss, and also the stock price going down, that's also inflating the option price and thus creating a potentially bigger loss. Double whammy. Now, the biggest actually thing is the investor might do here is they might want to say, look, I'm going to maybe raise cash. Why? Well, because if all of a sudden things actually start pulling back, they want to actually have some money to maybe, let's say, it could be new positions. I mean, who doesn't like to buy them cheaper? But the other thing is actually with this is I'm going to label this as dollar cost averaging. Now, here's the thing. I think this is actually very important here, because when things actually go down and maybe then they start to come back up, some of the ways you could try to actually do damage control on some of those positions is, if you had some cash, the investor might say, even if I just say, look, I'm going to add another 25% of a full position, I have some money to put to work. And so if you bought at 100 and the stock goes to 90 and you add to the stock at 93, all of a sudden now your break even becomes somewhere right around, let's say, 97. So all you've really done is you've actually increased statistically the chances of getting to the break even. It's very important. So what tends to actually happen is when the VIX is the lowest, investors' cash tends to be the highest. Do you think I'm not listening to what I just said? Did you just hear what I just said? Go back. When the VIX is the lowest, investors' cash tends to be the highest. Wash my mouth out with soap. That's not true. VIX is the lowest. Investors' cash tends to be the lowest because they've just got into positions. And we'll go over that in just a sec. Now, I want to actually kind of talk about in this situation, okay? What did we learn from this? Now remember, what are we calling this? The short-term failure pattern. I hope you say, James, I don't even relate to what you're talking about. I hope that's what you said. But if you say, no, James, keep talking, because I relate to it, I want to kind of talk about the strategy. The biggest thing you've got to ask yourself is, do you want to keep doing that? It's up to you. If you want to do it, hey, go for it, okay? Just go for it. Now, the investor might say, look, if they're going to build a position, now remember, how much was their portfolio? Let's hypothetically say 110,000. They have maybe up to, let's say, 12 positions. So if the VIX, let's say greater than, let's say 18, this is really when they're trying to invest heavily. And I'll show you what I mean by that, okay? And when they do that, they're really, in this case, trying to do cash secured puts, okay? Cash secured puts. They're also maybe considering, not saying you have to, short put verticals. And it's really strategies, okay, that could benefit to high IV. High IV, okay, high IV equals high premium. And when we say high premium, we're actually saying lower break evens, okay? Now, the biggest actually thing is, well, could they invest in stocks? Well, of course they could. They could say, look, new stock entries near horizontal support with potentially bullish MACD divergences. Hallelujah! Okay? Some investors might say, I'm not sure if I'd go hallelujah, but let's say they did. Okay? Now, the other thing is this. They might say, hey, I got some positions that pull back, and I want to do dollar cost averaging. Now, I know a guy that lives very close to me that's seen pullbacks in his lifetime. And that investor told me when he spoke to himself, some of you get that, the biggest actually thing is sometimes when the things pull back, the investor is fully invested, okay? If his name was Ralph. But the biggest actually thing is there's nothing worse and so why does the investor not have any capital? It's because they get sucked in on putting all their trades up near the top when the VIX is low. Now, I want to kind of give you just a quick picture. The picture is going to be worth 1,000 words here. Now, what I want to do is I want to show you something, okay? Now, I kind of went over this a little bit before, but I want to kind of re-emphasize this, okay? And I'm going to kind of there we go. So what I'm going to do in this case is I want you to imagine that this is the SPX, okay? That this is the SPX, and I ask you a question like, show me where you got in your positions. Now, you might say back to me, well, I didn't do SPX. I did XYZ. I did ABC, FGH. I don't care. Where did you get in? Well, what you're going to find is investors will actually tend to say, look, I got in one here. I got in two positions when the SPX was right here. And the other positions I got in here, here, here. And all of a sudden, what you're going to notice is when you look at the bulk of a lot of investors, the bulk of their positions are later into that trend. And the similarity is it's when the SPX, okay, it's up. And if that SPX is up, that actually tells us that the VIX is low. Now, why didn't they get in? They said they were a technician. Okay? But the biggest actually thing is they weren't trading technicals because there was maybe some entry signals before that. They got in because they finally felt like they felt comfortable enough to get in. You ever realize that it's not about feeling comfortable? It's about actually when you're seeing the setup. Feeling comfortable has nothing to do with technical analysis. It's just your emotions. Okay? Now here's the deal. I want you to self-reflect, okay? If you were to pull up the SPX and then go look at your trade history in the paid money account, plot on the SPX where those entry signals were on stock or option trades. I think you'd be blown away. Now, the biggest actually thing is what the paid money account is trying to do is when, remember, the SPX goes down, okay? The SPX goes down to try to change this short-term failure pattern or I'll say drawdown pattern, the SPX is down. And when the SPX is actually down, what does that actually mean? Well, that actually means in this case that the SPX, for example, not the SPX, excuse me, just reading a comment, okay? I was doing good. I just got wrong symbol, okay? Now, we're about done here, but this is really, if you miss the last 2 minutes, you're going to miss the whole point of what we're trying to do. If the SPX is actually going down, that actually means the VIX is up, okay? So remember, in 2025, in 2026, if we're guilty of anything, I mean guilty, okay? I think we've been very healthy in doing cash secured puts, CSP, and we're trying to, for example, do short put verticals. If anyone said, you're guilty in the paper money account in showing many examples of these, I would probably have to say, look, I can't hide. We've done a couple of those examples. Doesn't mean they're for everyone. Now remember, the biggest thing is when the SPX is down, many stocks are down. When the SPX is down, the VIX is actually up, and that actually means that we have high IV, and actually that means that we actually have high premiums. If we have high premiums, then actually that means we have low break-evens. That doesn't mean they're always going to be profitable, but you're trying to put the odds on your side. When I say that, there's still risk on every trade. Now, so if the investor says, look, I sold a cash secured put here, I got into a short put here, I got into a cash secured put here, and maybe the market still went down, whatever. But all of a sudden, if you kind of look at someone's trade, and this is what I'm speculating, if you look at someone that maybe doesn't have as much as that short-term failure pattern, you're going to see that the bulk of their trades were done in the trough of a pullback. It's not to say that they're not buying or adding here. The biggest actually thing is if you said, what's the difference between an investor that does this versus an investor that actually does this? It's the investor who actually puts on the bulk of their positions when the VIX is the highest, probably has the greater chance to not actually get in, only to see them down 250, 500, 750, down 1,000 on 8, 10, 12 trades. Now, that's not to say they can't be down, but the investor that does this number one pattern, okay, here versus number two, you'd say number two is probably going to potentially in the shorter term, maybe fare better than number one. Now, self-reflection. What's the self-reflection? Okay, the self-reflection is, now, James, have you been number one? Oh, darn right I have. Absolutely. Okay. Now, from trading, you want to kind of say, what have I learned from that? Sadly, I wish I was smarter and realized it sooner. Okay. Finally, okay, once you kind of get, the market kind of wakes you up a little bit, you say, geez, maybe if I had this thought one day, if I did the opposite of what I did, I would have been profitable. Have you ever thought that before, like about your own trade? Geez, if I would have done the opposite of what I thought, okay? Now, hopefully you never thought that. Well, I had that thought, okay? If I would have done the opposite. Now, the biggest thing of what I kind of want to say here is, so what are some of the tools that we actually have that we want to just be clear on to try to help us with the timing? Well, number one is look at the VIX, clearly. Look at the VIX level. Number two, when we're in trend number 4, you are really, really watching. When you're in trend number 4, you are watching. Because if all of a sudden it's VIX and there is a bull divergence on that, where's Lisa? Okay, now Lisa says she got an Apple phone. I want to see it for myself. The biggest actually thing is if it's a VIX, the VIX is low, down, but it's diverging. Look, I mean, you're watching. Because if all of a sudden now we start to actually pull back, could be in actually some trouble in those short-term type of trends. If we're in trend 4, clearly that's the time where are we going to break through? Are we going to start to pull back? One of the things we actually try to teach heavily is reading the higher lows. How do you read the higher lows? You look at the red and green candles side by side. The other thing we try to do to actually help with timing is Hold and CHE. And when we say that, we're talking about actually having those scripts right on the platform, which, by the way, you could actually put on your mobile device, whether it's an iPad or an iPhone. We're talking about seeing actually breakouts themselves, maybe like a 20, 55-day moving average. What do I mean by that? Well, if we pulled this back up, we can't say, well, I didn't see it. I didn't have the tools, whatever. Why was the investor late? Can't say we're late, okay? Shouldn't be. Why are we late? So the biggest actually thing is we also have a breakout column where we'll say, well, it will say breakout if it's breaking out today, if it's continuing since yesterday, continuing testing yesterday's breakout or broke out 2 days ago, whatever, bull or bear. Hence, that's why the color is green or red. We'll also have, for example, like say, these are all things that should help us stop just being late, okay? And maybe not being that number one pattern that was what I call the short-term failure pattern, okay? And so the whole moving average is counting the number of days the moving average has been green or red. Now, if someone said, well, I can't see it that well, I just can't see it. Well, if we go to the chart, there's labels. And so what this actually does is if someone says, well, I just can't see it. Well, here, let me help you even more. So if someone said, well, James, I couldn't see the entry on Hood. I just couldn't see it. Well, here, let me actually draw it in and say green candle number 1, green candle number 2, green candle number 3. These are all tools to try to stop the short-term failure pattern. And when I say short-term failure pattern, I'm talking about getting in and having a high likelihood of being immediately down, okay? Now, is that to say that the VIX can't be down for a long period of time? It could. Statistically, probably not really highly likely. It can, but it's just kind of trying to be careful, and it's trying to set up trying to be principle-based and practice-focused to put on positions when the VIX is high on purpose. Because when the VIX is high, that's when actually people's emotions come out and they start to sell, and they start to sell at lower prices. Why? Because the stock market is playing the game of mercy. You ever play the game of mercy? Bend that hand back, right? And all of a sudden those investors say, I can't take it anymore. And they tap out and they stop out or manually get out. And all of a sudden, that's when you can start to see those reversals on charts, okay? Now, I said we're going to take 10 minutes. I took 20, okay? If I were you, I would really go back and rewatch this first part. The reason why this got brought up is I took a phone call yesterday and I was talking to a friend and they were asking me kind of, if you were getting started over again, what behavior would you maybe try to really watch out for? It's what I just explained to you. Now, I don't really think of it all the time, but it's something if you're just getting started or maybe 2 or 3 years in, I think if you are number one, you got to be real careful. You got to say, how am I using the tools to try to help the timing? And how do I actually try to use the high volatility to establish a portfolio on purpose? All right, now, I'm not mad. I'm just saying that's kind of important to remember. Now, here we go. Now, by the way, how do you take those off? Okay, so what I'm going to do is I'm going to go back to that right there. Let's go back to the labels right there. By the way, that's the chart I've been always sharing. I'll share that in just a moment. I'm just going to take them off. No. Okay, now let's go to work real quick. I'm going to fast fire through a couple charts and then we're going to let them rip. Okay, so here we go. First chart I want to pull up is that RUT. Okay, now what I said last week with Kevin is, if you look at kind of the pole that we built, you look at the shallow pullback. Now remember, I've always been consistent in saying this. If we pull back less than 3 days, what's the M word? The M word is momentum. That's right, okay? Now, so here's the thing. We pull back uno, dos, and you're going to see in this case, green candle. Now, the newer investor would say, I'm looking for a deeper pullback. Well, this paper money count isn't. The shallower the pullback, the stronger the momentum, potentially the stronger the trend. Now, when you actually take a look at the Russell 2000, classic V pattern. What might this potentially mean? Now, by the way, what does this have to do with sentiment? If people are buying, let's say, small caps or NASDAQ, this is kind of telling us, now I'll conclude this. If they're buying small caps, if they're buying NASDAQ, if they're buying semiconductors, discretionary stocks, and so on, this is all those growth type of areas, okay? So pretty strong actually move in the Russell. And Bill, I'm sure you never saw that. When we actually take a look at the NASDAQ, is it like the small caps? No, it's not. The NASDAQ had one down day, or at least a red candle, I should say. Today, we're down a whopping a tenth, slightly more than 0.1%. A tenth. Okay. When you look at the Dow Jones itself, it kind of looks like we're back up near resistance. Okay. Can we actually get above that? If we actually close, let's say, higher than that, which is 479.21, that'd be the second highest close ever. Now, if we go back to where was the higher low? Remember I said before, I'll say it again. But don't worry, I have short-term memory loss, okay? I literally do. I have 4 kids and they've done it to me. The big actually thing is when you look at the red candle, green candle, if someone said, yeah, I'm nervous to get in, well, you'd probably stop saying that if you could actually see where the higher low was. The higher low, red, green candle side by side, draw the line at the open of the green candle. And for most short-term investors, that's probably where they're setting the stop loss. If they actually if that trade starts to go below 474.15 or so, they might say, hey, that little breakout is not actually holding. The key word is so far. Volatility, when you actually pull this back up, when you look at the VIX, we're down here at 1596. Remember what we said, when the VIX is high, it could be the time to buy. Come on down. Some investors might say, when they say come on down, they're saying come on down the price down to horizontal support, which some of those stocks can start to do divergences and bounce. If we're getting a bearish cross down on the VIX, that actually means we got a bullish cross up on many stocks. Stocks, real quick, when we pull this up, pretty strong move. Kind of looks like the rut. If you don't like the color green, this is not your chart. Now, the biggest actually thing, if we take a look at, let's say, the IXI, meow, okay? We'll come to that in just a sec. If you take a look at the industrials, they've actually had a pretty strong move. Energy has actually kind of been strong, which has kind of been interesting. The technology space, okay, fine. Hasn't reversed quite yet, but I'd probably say the one that we need to mention because we got an example on that has really been the transports. Now, when people talk about recession, you could say there's recession probably somewhere in the U.S., somewhere. Transports, if that's actually going up, that's not a very good indicator of recession. Okay, now you can get weaker numbers on different fundamental data points, but with that chart's going up, financials are going up, industrials are going up, there could be a recession in the economy, but in terms of the stock market, that's where we're seeing a little different. And there could be differences between what the economy is doing, Main Street versus Wall Street. Now, what I want to do is I want to kind of pull up just real quick a couple stocks. Now, let's start with transports real quick, okay? I need to go to transports real quick because one of our examples is Delta, okay? Now, what I'm going to do in this case is we had a trade, and what you're now going to notice is we're very, very close to the target. Now, if you don't mind, I need to use this little sheet of paper. Let me get a new sheet of paper. I'm just going to mark the numbers just very quickly, okay? So what is the target? Well, that target right there is 6901? Okay, so I'm going to put 6901. That's the target. If I look at where I'm going to put support, if we have one or we need to talk about that, I'm going to put the stop. Where's the stop? Well, that stop is actually right at 6121. So 6121, and we're going to write, for example, entry, and I'm also, if we need to talk about that, and I'm also going to write current price, okay? And I'll make this a little bit bigger. Current price. What is the current price? Current price is 67.79. Now, I don't really care about the entry so much. What I really care about in this case is when we get, let's say, within 1 or 2% of the target, I'm going to say 1%, I'm going to say 2%. Now, what am I going at? What am I saying here? Well, because remember, if this is where we're trying to sell 6901, if we start to come in that vicinity, that would be 68.31. Now, we're not there yet, but we're getting close. If I actually said, look, our target is 6901, but if we get within 2%, you're going to see that right now the current price, and we're within 2% of the target. Now, all of a sudden, the alarm bells start going off. And that investor is probably going to say, well, what is the reward remaining? Okay? What's that reward remaining? So when you start getting within 1 or 2% of the target, your reward becomes bigger and bigger. Is that right? Did I say that right? Tell me no. It's not right. It's the opposite. We're trying to get that last what? Now, here's the problem is when we're trying to get that last piece, that last $1.22, where'd you get the $1.22? The difference between the current price and the target. Are you with me? Now, gosh, if you're sitting back and I ain't paying attention, this is not the time to be doing that right now, okay? If you're on the phone, hang up. If someone's talking to you, say not right now or join in with us. The biggest actually thing is when we actually talk about the current price down to the stop, when we talk about the risk, that risk in this case is going to be between that and that. So what you're now going to notice is 1.22 is the reward and 658 is actually the risk. So it's like a 1-to-5 ratio. Now I've said this over and over again. If that reward risk ratio is 1-to-5, 1-to-6, and so on, it becomes a trade where you might say, look, I'm not going to sit in here and give it all back. Okay? Now, how close? So in this case, if we're within 1 or 2% of the target, right now we are within what? We are within 2% of that. Now, if I said, well, how much more do we have to go? We have $1.22 to go to that. So what I'm going to do is I'm going to move up my stop. What's the current price? And let's just say the current price is the highest price. And let's be consistent. What was the highest price here today? The highest price was $67.94. So if you said, James, I didn't see the higher price, the answer is it doesn't matter because we're taking it from the highest price. That is going to slightly affect, and I'm going to do this so we can see what that reward was, $67.94. The reward was $1.07. So what are we doing? I'm going to take the current price, the highest price, $67.94 less $1.07. We're talking about 15 cents. And the stop is going to be moved to $66.84. Let me repeat. So when we get within 1 or 2% of the target, the reward becomes small compared to the risk. We're going to take whatever the reward was at the highest price, not when you saw it. And now what we're going to do is we're going to move up the stop. How do we do that? We're going to move it up to what price? 66.87. If I move that up, 66.87, now what you're going to notice in this case is, James, now the target and the stop becomes very close, and that is true. Now, I've said this week, and I've harped on it. We cannot say language like, I locked in my profit. You didn't lock in anything. All you did is adjust your order, okay? A stop is a trigger to sell. We can't say that we locked in any profits because we haven't seen what it's going to fill at. If it's a trigger sell, it could fill a lot lower than that. We need to understand that, okay? Now, the biggest actually thing is when you take a look at this, so that's trade number one. We adjusted the stop on this, okay? Now, trade number two is when I come back to this, is when I look at Morgan Stanley. Let's kind of practice the exact same thing. Notice we actually on Morgan Stanley had a target. We have a stop. Let's run the numbers again. So what was the highest price here today? Well, we can see it on the chart. It was 176. Okay, 176, type it in. What was the target? Target was, what do we got? Target, I got like 176. I mean, let's say it was 176.05. I can't get a number because it looks like it's literally, let's say it was 176.10. Okay, not much of a difference. Now, did the price get within 1% of the target? It did, because the current stock price is above that number that I'm highlighting. It's above this number. Now, what you're going to notice is if we were trying to target out 176.10 and it got to 176, that means there was only a 10-cent reward left to what the target was. Well, where's the stop? And this one's even kind of sillier, okay? The stop is all the way down here at 158. So when you look at these numbers, let's say it's 158, you're trying to get the last 10 cents and you got a risk of 18. Now, a lot of times people, they don't like to make decisions, okay? In the stock market, you're having rule sets to help you go through the checklist, so to say, to manage a position, like we're practicing. So in this case, what we're going to do is, since we've already gone down below that, the stop would be right around like high 175. We're mainly just going to go in, move up that stop to where the current price is right now, and manually exit the position. Why do you say that? Well, because if we did what we did on the other one, this one should have already triggered out to be sold, but we would need to see where it filled. So trade example number one was Delta. Trade example number two was actually Morgan Stanley. And the one that I also want to just kind of mention just real quick is a short put in the margin account. We're talking about new positions. The short put on the Wheaton Precious Metals. Okay. Again, this goes back to the framework of management, right? So if we said, hey, look, how many days have we been in this trade? Example, this has been in about 3 weeks, okay? So the rule of thumb we always talk about, if we get 50% in the first 10 trading days, well, that doesn't apply because we're past that. If we get 65% if we get 65% and there's more than 20 days remaining, wait, does that apply? Yeah. You got, in this case, you got 72%, okay? Or you get 80% ever. I'll repeat, if you get 50% in the first 10 trading days, that's like a great trade. Timing was probably impeccable. 65% with more than 20 days left. Now, again, don't take this as a negative. We got 65% with 15 days. So this is even like stronger than what I just said, or 80% ever. So what I'm going to do on this, when I go back to WPM, help me with this, okay? Don't just make me do it all myself. When I look at Wheaton WPM, is this something you would roll, okay? Profit taking up a new position, or would you actually say, nah, James, I would just kind of take the profit, do not establish a new trade on that. I don't really see it being a bounce or a breakout. Any thoughts on that? Now, if you ask me, is this bouncing? I would say, kind of. I don't see it go hold yet. I don't see a breakout. So this would steer maybe some investors to say, look, James, I'm just going to right-click on this, create closing order, and then buy it back. They might just say, look, I'm going to profit take. I don't see a bounce yet. I don't see a breakout. So the difference between someone just profit taking, I have the percentage I'm looking for, and I don't see a new bullish entry. That's why it's just profit taking. Click on that. We're now going to go to buy it back. We're going to click on the 65 cents. Now, again, that doesn't mean it's going to get filled. We need to make sure, does it get filled? Confirm send. Note the commission. Check. Send the order. Let's see if it gets filled. The closer we get to expiration, the harder it might be to actually get a fill. Okay? Now, the stupid example, but I'm going to say it anyway. Imagine you go to a grocery store and you got 3-gallon milks, and they're going to expire in 1 or 2 days from the time that you're looking at it. How many people are going to buy those? The closer you are to expiration, you might not turn over that inventory as much. Kind of the same thing goes with the options sometimes. People want something with a little bit more time so they have more options to use it to have a right or an obligation. Odd example, but hey, we'll go with it. Now, let's kind of talk about some new examples here for just a second, okay? Now, what I want to do is I want to look at some examples, and I just want to fast fire through a couple stocks. IBM, that's going to be one that we kind of keep an eye on that kind of has like a diagonal slant to it. It's not breaking out, but going into, let's say, this afternoon into Friday, we're going to keep an eye on that, okay? The one that we talked about financials quite a bit yesterday. We see American Express getting a little push there. We see Goldman Sachs, some people say Goldie Sachs, but it's Goldman. You're going to see that it actually made a brand new high, didn't close there. You're going to see that if we take a look at, let's say, Apple, we finally have a pullback. Now, some people might say, well, that's horrible. I can't, it's horrible. But you got to remember, it made that bull flag pull. Now, this trade might surprise you, okay? But some people might say, look, old resistance in this case being new potential support. Now, what we're going to do is we're going to make a conditional order on this. We're going to say, look, if you can come down, and I'm not just going to do it a little whisker right below today's low. If we can come down to 279.50, sell the put. So the entry of the put is conditional upon the stock coming down to the support. Now, how many of you have ever tried to do this? Look, I missed the breakout. I don't know why you would miss the breakout, because there's about 47 different entry setups, okay? But sure, fine. Let's play the game. The investor missed the entry. And now they're saying, okay, now I'm going to try to buy on the dip closer to support, and they're going to try to get in. Now, I'm going to go to Trade tab. I'm going to go to actually type in Apple. I'm going to come up to the position. Now, by the way, one other thing I want to say. The reason why this paper money account only looks mainly at the Dow 30, the NASDAQ 100, and the S&P 100, which is 230 stocks, but when you overlap those lists, it's like 191, because some stocks trade on the Dow that are on the NASDAQ, some stocks are on the S&P 100 that are on the NASDAQ 100 too. So what this actually does is, when you have a smaller number of stocks, you probably have a greater likelihood that you're more in touch with what's all going on in those stocks, because you're not making a new list every day. And the only main reason why we probably look at the S&P 500 is probably because you're looking at casino stocks, home builder stocks, and our airline stocks. Three main groups, okay? Now, trade example of what we're going to do on this is we're going to try to sell the first out of the money steal, right? We're going to sell that put by clicking on the bid price, and we're going to go over here to where it says limit. So then we're saying, hey, look, no, don't sell yet. Sell if we go, and I'm going to do day, not day order, GTC. I don't know if it's going to fill today. I'm going to go over and click on that gear right there. And I'm going to say, look, I want you to come on down, get a little bit closer to support. And we're going to say, look, if you come down maybe a quarter lower than you are right now, the investor says, look, I'm okay with trying to get in at the market price of the 275 put. Ding wants to talk about kitty cat. Yeah, we'll come to that in just a second. Now, the biggest actually thing is when you take, and don't forget Hood. For crying out loud. No, did anyone say Hood? Now, here's the deal. So we're just about 20 cents away. Now, the moral of the story is you could say, well, I would do it a little lower. I'm trying to get the order filled. That's why I'm doing this. Okay? We're going to go save. We're now going to go confirm and send. So is this a right or an obligation? If you sold the put, you got an obligation. Obligation to do what? Be the buyer of the stock at the what? The steal, right? Price from now to expiration. The premium, we don't know what the premium is going to be. We know approximately. We don't know the exact break even because I don't know what the premium is. Okay? And that's going to affect the profit, and that's going to affect the max loss. We can have a pretty good idea of what that's going to be. Okay? And you can figure it out pretty close. We're going to send the order. Now, what I'm going to do is let's take a quick peek at CAT. Okay? I don't have anything to say on CAT besides doink, brand new high. Now, remember, we said that yesterday. If you look at the tail, you could probably measure the first down. Okay? I mean, that was a very interesting, and when I say first down, I'm saying you can measure the tail. It was almost 10 yards long yesterday, and yesterday it wasn't up at the high, but it rammed its way into the close. Now, you didn't know what it was going to do the next day, but it's up a couple more dollars. Money doesn't buy happiness. Anyway, more of the story is, if we look at the next one, I want to go back to a stock, and I want to go back to, let's say, a stock, and I want to pull up just real quick C, okay? Now, one of the stocks, so I'm going to bring this up for just a second. So this is kind of broken out. Now, one of the other tools we actually talked about that should help is kind of identifying maybe when the stock has gone up, maybe it's a little high. This is trying to help us with timing. Now, remember, this right here is the 10-period moving average, okay? This right here is 3% above the 10. That red line, 5% above the 10, okay? That line right there is 7% above the 10. And you'll see that right there, and yellow's not on there, okay? So let's say the investor says, look, I'm going to buy, but I want to do a strategy that's like, that has defined risk. So in 60 seconds or less, now remember, what did I say we're going to practice? If we're buying a little deeper into it, what's a strategy that might have a built-in defined max loss, but also a max gain? And the answer is a collar. What does a collar look like? Well, number one is we're going to buy the shares of the stock. which is not too bad. Click on the ask price. There's 100 shares. If I click on the ask price and I can now go single order, first triggers SEQ, what I'm going to do is I'm going to go look at the monthly options, 20, 50 days to expiration. Fine. Then what I'm going to do is I'm going to go look at the options that maybe have a delta of 30 to 40. The delta that has a delta, the strike that has a delta of 30, 40, or closest to it, is the 115. So that means if we now click on the bid price, that means we have from really 108 up to 115. That's the cap. Now here's the deal. We're not trying to grab that income just by itself. We're trying to grab that income so we can come around here to the delta, let's say 30 to 40-ish, and try to buy the put. Now, what you're going to see in this case is it has a debit of $1 because the strike for the put is low. The strike of the put is closer to the current stock price, and we could run those numbers. But this will be our final trade here. Why are we actually doing this? Because we're a little elevated. How can we see that? On the moving average envelope, we're at that red line, which probably signifies that, hey, if this flags back, what's a strategy that might be able to handle that pullback a little bit more better, meaning a lower delta, okay? Now, in today's class, for the first 20 minutes, there was some heavy concentration of like some material that you really need to absorb. You need to go back and listen to that, okay? And you need to also kind of think about, are those some of the things that you actually saw in your own paper trading? I want to thank Connie Hill for answering those questions in chat. I'm out of my time here today, but I set out what we really wanted to do. And I want you to think about kind of your strategy. Are there things that you would improve based upon our initial discussion here today? Stay tuned for our next webcast coming up right at the top of the hour. This has been the class on Trading the Trend. I'll be back on tomorrow with Kevin in the morning on ETFs. Join us. It's live only. Thanks, Connie, and thanks to all of you. Take care and stay tuned for our next webcast coming up next. Bye-bye.